Mm, mm.
Hello, everybody. Welcome to the webinar. We are very happy to have you all from everywhere. So I cannot say good morning or good evening, but just good day. We are going to talk today about the US tax updates and what kind of opportunities there are for corporation. Thank you everybody for coming. I will present you very quickly the 5 speakers that we have today. And then they will actually do the presentation. At the end, we'll have a Q&A. If you have any questions in the meantime, please use the chat box and we will answer that at the end of the sessions. So I'm going to introduce now Shishir Lagu, who is the manager and the partner here at Kenevi, managing the team. With him, we have Simon Alting, Kavit Shangvi, Dharmesh Desai, and I think that's it. I hope I didn't forget anybody.
And Pratik.
And Kavit. What? Oh, I missed someone.
Pratik. That's fine, Christy. Yeah, Pratik. We have Pratik with us.
Pratik, of course, Pratik. I'm sorry, Pratik, I missed you. Okay, you can start, Shishir. Thank you.
Thanks, Christine. Good morning, good afternoon, good evening, from whichever part of the globe you are attending this webinar for. Thanks for attending this session. Hope all of you are doing well and keeping safe. 2020 unfortunately has been the year to kind of really forget or maybe remember just for the wrong reasons. The pandemic has literally taken toll of the life, the health, the business. The US GDP declined by 3.5% in 2020, which is the highest after 1946. This was the first time after the Great Recession of 2007-2008 that US economy was in the red. However, as per the report of Jeffries, which was released in first week of March, we understand that the economy is kind of recovering and it is back to 85% of where it was 1 year back, which is an extremely positive sign. And given the fact that there are the pace of the COVID cases is slowing down and the pace of vaccination is going up, definitely the economy is expected to improve. So that's a big positive. Having said that, whilst the US was going through this difficult time, or rather the globe was going through a difficult time, but US in particular, the US government definitely did or take some measures to help the businesses, and it provided a lot of incentives, grants such as the PPP, ERC, deferrals, and so on and so forth. However, in spite of there being the difficult times, the federal and state continued to issue a lot of guidelines, the updates on the tax front, which the taxpayers and tax consultants need to be mindful of when they are filing their 2020 tax returns and planning for their 2021 taxes. One more important change which happened during 2020 was Biden and his Democratic colleagues coming into power in a dramatic fashion. And the change in administration kind of means the change in tax law as well to a certain extent. And whilst there is nothing crystal clear at this point in time, Biden in his tax plan kind of laid down certain broad principles or the changes which he is looking at. So important to keep them in mind as well when you are looking at tax positions of the company in the coming years. We will try and cover most of these aspects during our today's discussion. And for that, I have with me my colleagues, Simon Elting, who is an associate partner with KNAV, Kavit Sangvi, who is a senior manager with KNAV, and then we have Dharmesh Desai, who leads the salt practice, and Pratik Manani, who leads the transfer pricing practice with KNAV. So as a group, hopefully we will try to address a lot of points on the US tax updates and the planning opportunities, and looking forward to having some good questions from all of you. We would try to answer them at the end of the session. So, Kavit, we start with you. So, like I said, I mean, there were quite a few incentives which came in, and one of which was the PPP. Uh, though it came as a part of the CARES Act, it was definitely extended through CAA as a PPP round two. Uh, as of the SBA report of March 21st, approximately $718 billion of loans have already been disbursed, and another 88 billion available to be disbursed. Uh, it also comes with tax implications because there were a lot of changes which were kind of happening in terms of taxability of PPP. So, Kavit, can you share with audience some thoughts with respect to this PPP round two, and more importantly, the tax aspects which are associated with PPP?
Sure. Thanks, Sushil, for providing a background on the PPP aspect. So, as rightly put out by Sushil, this PPP loan, which was introduced as part of the CARES Act, brought about a huge benefit for the businesses and payers. And also, this was one of the provision which interested, which kind of caught the interest of most of the businesses because it was a pure cash benefit, and also the forgiveness aspect that if certain conditions are met, the loan will be forgiven, and that was the most important aspect that led to this catching the attraction of a lot of businesses. So as we were, we're getting a lot of clarifications on the first version of the PPP loan. The IRS has now, kind of SBA has now announced the another PPP loan as well, which is introduced as part of the CAA. And I would just highlight a few eligibility criteria on that. So the first is that it is eligible only to those businesses who were eligible to obtain the PPP1 loan. And additional restrictions are that there must be a 25% reduction in gross receipts in 2020 as compared to 2019. This condition was earlier not present on the gross reduction, but now they've brought in the additional condition. Also, on the participants eligible for this loan, earlier there was a threshold of 500 employees, but now it has been reduced to 300 employees. And again, the most important and most confusing aspect was the affiliation rules, where there was a whole lot of ambiguity with IRS coming up with various clarifications on this. So ultimately, it has been finalized that the employee threshold and the reduction in gross receipts, which is part of the PPP2, will now have to be looked at a worldwide level, at an affiliated and called a control group level. So this is something that needs to be kept in mind, which now has which now has a great clarity, and there cannot be any confusion regarding this on affiliation rules. So that's it on the affiliation part. And then again, the due date for the PPP2 has been extended to May 31, which earlier was March 31. So applicants who are now getting more clarity and want to apply for this PPP loan can just go ahead and apply, and they have 2 further months to think over it. Then there are, as Sachin pointed out, there are also tax impacts which need to be considered on this. So while in the CARES Act it was very clear that the forgiveness of PPP loan would not be considered as income, there was no clarity on whether the expenses that have been incurred out of the PPP proceeds, whether it would be allowed as deduction or not. So IRS later came up with a clarification that the expenses incurred out of PPP proceeds will be disallowed for tax purposes, and which was widely opposed by a lot of businesses because it seemed to be against the intent of the CARES Act as well as the intent of the government, which was ultimately to provide cash benefit to the businesses in times of this pandemic. So, as part of the CAA, when PPP2 was announced, it was also clarified that expenses incurred out of PPP proceeds will be allowed as deduction, bringing a huge relief for the businesses. So, I guess this is about the PPP eligibility and the PPP tax impact.
Sure, sure. Thanks, Kavit. And over to you, Dharmesh. We all are aware that each state is a country in itself and it's unique and it may or may not necessarily conform to the federal tax treatment. Similar is with PPP. So, Dharmesh, what is your take in terms of PPP taxability by the states, whether all of them are conforming, whether some of them have a different treatment? If you can share your thoughts on that.
Sure, Shishir. Yeah. The federal tax position is well settled. That's true. While a lot of states conform with the federal tax treatment, there are few states which tax PPP forgiveness either because they treat foreign loans as taxable income. These are generally those states which have an IRC conformity date prior to CARES Act, or because they deny the deduction for expenses paid for which the proceeds from foreign loans were given. These are generally the states which conform to the provisions of the CARES Act but do not conform to the CAA Act. So as of now, there are 12 states who do not conform to the PPP provisions. But like we said, even in the previous week, there were updates. Quite a few state updates had come regarding the PPP conformity. And let's wait and watch if this 12 state also confirm or they do not confirm in the future.
Sure, sure, Dharmesh. Kavit, again, coming back to you. So, just like PPP, another interesting incentive which was brought in by CARES and further modified or enhanced by the CAA and ARPA was with respect to employee retention credit. It definitely gives a lot of benefit to the taxpayer, especially in the light of the fact that it's a refundable credit. And there were a certain level of relaxations which came in, especially in the 2021 edition of ERC, if I have to call it that way. So, given that quite a few of the clients would be eligible for this ERC or may have already taken the benefit of the same, can you share some light on the ERC, especially the 2021 changes which has come in and the income tax implications thereof?
Yes, absolutely. Absolutely. I would say this is also a significant benefit that was introduced as part of the CARES Act to encourage employers to retain the employers during the pandemic. And as you mentioned, the modification that has been brought out for the 2021 and also some retroactive changes. So that has further boosted the claims of this credit. So one of such changes what was brought about was that earlier the taxpayers who had obtained the PPP loan were not eligible for the employee retention credit. Now this restriction has been removed, and now all the taxpayers can opt for this employer retention credit subject to meeting of other conditions. So there is no restriction on availing of PPP loan. Now this has led to a great benefit to the taxpayers because now they can go and retroactively amend the prior year payroll tax returns and claim the employer retention credit for 2020. So this will give a huge cash benefit, and as mentioned by Sushil, it is a refundable credit. So purely a cash benefit for the taxpayers and the businesses. Then there was also a few changes that brought out in the 2021 version. I would say that the credit rate has increased to 70%. So now 70% of the qualified wages determined are eligible for are basically the credit amount, and as against the 50% that was introduced in 2020 ERC credit. So this has led to increased employee retention credit, as also the maximum cap on the ERC per employee has also increased from 10,000 per employee in 2020 to 28,000 per employee in 2021, a straight $18,000 per employee benefit given to the employers. So all in all, I would say it's the ERC version of 2021 and also the changes for 2022 for the PPP has brought in about a great benefits. Now, again, like PPP, the ambiguity still persists here with respect to control or group or affiliation rules, like whether to include the foreign affiliates in the computation of ERC and other like ERC and gross receipts calculation is still not clear. While there are some views that foreign affiliates are to be considered for gross receipts calculation and also and also foreign employees to be considered, there are some views that only the gross receipts connected to the US trade or business and the US employees of such group are only to be considered. So IRS has not issued any clarifications on this aspect, but as a view from KNAV point of view, we would say that we believe that the gross receipts pertaining to US trade or business and only the US employees of the group need to be considered for the purpose of ERC computation. So ultimately, I would say a careful planning and analysis needs to be done while analyzing the applicability of ERC to certain businesses, and especially in light of the government shutdown rules and various orders that have been released, what kind of activities, whether done or not, would qualify under shutdown is something that we need to evaluate in detail and understand the business in detail, and which will help us to take optimum benefit of this provision.
Sure, Kavit. I guess the key words or the key takeaways from what you said is benefit and ambiguity. So, whilst there is a lot of benefit on the table which is available for the taxpayers, there is a ambiguity as well, especially with respect to the affiliate rules. And hopefully, IRS comes with a lot more clarity on it sooner than later, so that a rightful benefit can be availed by the taxpayers at the earliest. Kavit, the third thing, I guess, let's just extend on to this benefits itself. So the PPP was one, ERC was second, and third one was with respect to the deferral of the payroll taxes. So that helped the taxpayers definitely from the cash flow perspective, but it came with its own set of income tax implications as well. So whilst it can lead to adverse tax implications for certain taxpayer, it can lead to an opportunity or a planning opportunity for others as well. So can you shed some light on the payroll deferral and more importantly on its income tax implications?
Yes, sure. Again, this provision, as you rightly mentioned, that it provides a significant cash flow benefits to the taxpayers because employer-related payroll taxes form a significant chunk of the cash flow management, and it does provide a significant benefit because the deferral starts from March 21, 2020 to for payroll taxes incurred till December 31, 2020, and the payment is to be done 50% in December 2021 and 50% in December 2022. So a significant time frame has been provided. But again, what aspects we generally ignore is the tax aspect related to these benefits, and that is where we are just wanted to highlight on the tax impact of this. So the deduction for payroll taxes for accrual basis taxpayers is generally claimed within a period of 8.5 months or before filing of the tax return, whichever occurs earlier. So just taking example of a calendar year taxpayer where the due date, suppose it's a corporation, the due date is April 15, extended due date is October 15, 8.5 month period ends on September 15. And the due date for 50% of the deferral amount to be paid is December 31, 2021. So if the taxpayer has not paid the amount by September 15 and while filing the extended return, the taxpayer would need to disallow the entire amount of deferred payroll taxes. and that is ultimately going to impact on the tax cost of the company if that was not earlier considered while filing extension or estimated taxes, and the taxpayer might have to pay significant amount of interest or penalties. So there is something that needs to be taken into mind while consideration, and the companies need to evaluate and do a cost benefit analysis whether it makes sense to pay the deferred payroll taxes or to just bear the tax cost for the disallowance of payroll taxes. This needs to be carefully planned again. And then for extreme example, for Marchian taxpayers, the original due date being July 15, extended due date is January 15, and the 8.5 month period ends on December 15. So for them, it might make sense to take extension and pay the taxes before December 15, at least 50% of taxes, because the due date is anyway December 31. So just a 15 days gap, and they might want to pay taxes by December 15 and take claim the tax benefit for that. So I guess all in all, this is how the tax impact will work, and the companies would just need to plan around it.
Sure, definitely, Kavit. So I guess it definitely needs a careful planning in terms of when to claim a deduction, because there is also an expectation of increase in the tax rates. Hopefully not for 21, but maybe 22. So whether the taxpayers want to pay off the entire chunk of the payroll taxes which they have deferred in current year itself, like you said, maybe before 15 December, and claim the entire deduction in 20, or want to actually kind of defer a deduction, maybe say to 21 and 22, and if there is an increase in tax rate, that gives them a benefit of a deduction at a higher tax rate. So I guess multiple considerations which one needs to keep in mind when taking a final call as to how they want to treat the uh, deferral of these payroll taxes. Uh, Dharmesh, let me come to you for a state part now. So we heard a lot from Kavit about the federal. So want to divert a little to the state now. And states also during the year kind of came up with the changes on the apportionment methodologies, on the service revenue apportionment, the tax rates, which impact the tax year 2020. And that is something what we will now be getting into the preparation of the 2020 tax returns. So quick three, four, key pointers on the changes one must look at when preparing the 2020 tax return.
Absolutely, Shishir. So while there have been major updates at the federal tax regime, but for state tax purposes, what we have observed is that over the years, there is a general trend which almost all the states have followed. So if I take service revenue apportionment, for example, there has been an inclination that states would be adopting or are adopting market approach methodology, while big states like New York and NJ both moved to market approach in the previous years. In the current year, there are four states, namely Hawaii, New Mexico, North Carolina, and Vermont, which have moved to the market approach methodology. There is one state, with the state of Kansas, which has moved from a pro rata approach to a preponderance approach. So this has, for the past 2-3 years, we have seen that more and more states are moving to the market approach. Next point coming up is the apportionment rules, and states have started, for the past 3-4 years, started giving more importance to the sales factor in the apportionment factor. So for example, a state like Tennessee has given a 6 weightage to sales, while given 1 weightage each to payroll and property. There are quite a lot of other states as well who have given double weightage or triple weightage to sales, and more and more states have also moved on to the single sales approach. So in the current year, there are two states, namely Delaware and Missouri, who have adopted the single sales approach. Coming to the tax rates, there are no major tax rate changes other than the state of Missouri. For Missouri, the tax rate has gone down from a 6.25% to a 4%. But for the other states like Colorado, Indiana, and New Hampshire, there have been marginal rate changes. Indiana, the tax rate has been changing, reducing for the past 3 years, and this is the last year that the tax rate will be reduced as per the state guidance.
Sure, Dharmesh. I guess there is one more point, from a 2020 perspective, which will become extremely critical from a state perspective, is the change in the business model, or probably the compulsion which got created in last year, leading to a work from home situation for the employees. And earlier, the employees who were working from the office location moved to their homes and started working from home. And the question started to arise in terms of the state nexus, that whether the telecommuting employees who are now working from home creates the nexus for the company in those jurisdictions and a requirement to file the returns in those states. So is there any clear guidance from the state in terms of how they are going to view this temporary presence of the employees across the multiple states?
Sure, Shishir. So, COVID has affected all our lives. So, work from home has become the new norm. And wherein, for state perspective, for the US state perspective, it has been very important because having a employee in the state would ideally create a nexus and filing requirement for most states. But due to this COVID, there are around 22 states in particular who have come out with guidelines that in case of a temporary change in a employee location. If your employee is working in my state for a temporary period due to COVID, then it would not create a nexus or a filing requirement for income tax and payroll taxes as well. So there are 22 states which have confirmed, but there is one state, the state of Michigan, which has said that even if your employee is working on a temporary basis at a location in Michigan, you will need to file an income tax return or you will need to file a payroll tax return. But then again, Shisha, there are quite a lot of other states who have not come out with any conformity or any guidance regarding this commuting of employees and the temporary work stance.
Sure, that's interesting to know, Dharmesh, that we are already towards the end of March, and you said only 22 states have come up with a guidance, which means that there are another 28 which have not yet issued any guidance. So as we really embark on our 2020 tax return preparations, the key question is going to be how we do the payroll apportionment for these states and what kind of a data we would need from the clients to really prepare the returns. I mean, earlier it used to be pretty straightforward in terms of where the employees are performing the services, we get the data. But now the performance of service, especially on the temporary basis, can lead to a very different equation in kind of gathering the information. So I guess, a lot of analysis further will have to be done in terms of, how the payroll apportionment will have to be done on the 2020 tax returns. Kavit, coming back to you, and while Dharmesh provided some insights into what needs to be looked at on a 2020 tax return, and you definitely mentioned about the three key points from the CARES and its implication of income taxes. But there are other provisions as well, which one must bear in mind when preparing the 2020 tax return, which can have an impact on their taxable income position or the overall tax return position. So can you share your thoughts on maybe a top 2 or 3 points which you think are extremely relevant from a 2020 return perspective?
Yes, sure. So there are, I would say, I would cover around three benefits that were introduced as part of the CARES Act and which will phase out after the 2020 tax year. So the first one is the restriction on the NOL utilization. So as part of TCJA, there was a restriction imposed on the utilization of losses generated post 2017, and they will be allowed to be utilized only to the extent of 80% of taxable income. Now, this restriction rather, was removed temporarily for 3 tax years, 2018, 2019, and 2020, as part of the CARES Act to provide some benefit to the taxpayers. So 2020, I would say the last year that the companies can avail benefit of utilization of 100% of losses that might have been incurred in 18 and 19 against if they have a taxable income in 2020. So this might be a good year if they have some profitability and they can utilize it fully. Then the next benefit was that carryback. So the TCJ had eliminated the carryback provision, but because of pandemic, as part of CARES Act, the carryback provision was reinstated temporarily for the losses incurred in 3 years, again in 2018, 2019, and 2020, and which can be carried back up to 5 preceding years. So a lot of our clients, we in fact filed carryback claims and generated a lot of significant cash benefit as part of this provision. And it can there's still an opportunity left for 2020 tax year to if there are losses to claim the carryback and this generate significant cash refunds out of this carryback provision. So there can be significant benefit because the tax rate now is 21%, and earlier before TCJ, where the losses can be carried back, the tax rate was somewhere around 34-35%. So there is a clear-cut benefit of almost 13 to 14% when while carrying back of the NOLs. And also, we don't know if there are significant losses. The taxpayers might not have a visibility on when the losses might be utilized in future. So it's a good opportunity to claim immediate carryback and get a cash benefit on account of carryback. Now, there are also certain tax accounting considerations that that one needs to keep in mind with respect to carryback. So if a taxpayer has been making huge losses, suppose for 1 or 2 years, generally what we do is we ask for protections and see whether there is reversibility for the annuals in future. And if there is no reversibility that we can foresee, we will not recognize any deferred tax asset on that. But now, because of carryback, if there were profits in prior year where the losses can be carried back, we have a visibility on utilization of these losses by way of carryback. So we will surely recognize the deferred tax on such losses. And also, deferred tax will have to be recognized at the effective rate on which the taxes were paid in the year in which the losses will be carried back. So this is something that obviously has been done for some of our clients where we have carried back, and also will be done in future for 2020 tax year if there are any opportunities for carryback. Now the next is on the 163J. So this was also relief was provided under CARES Act that for 163J the limit for one-street disallowance which was 30% as per the TCJ was increased to 50%. So again, this led to some relief on the disallowance of 163J and an impact on taxable income, reduction in taxable income for some of the taxpayers. Again, this is the 2020 is the last year where we can avail of this benefit. One more benefit that was announced was that under 163J was that for tax year 2020, taxpayers can use the taxable income or loss of 2019. So suppose if someone has a profit in 2019 and because of pandemic they were lost in 2020, they can opt to take the benefit of using the adjusted taxable income 2019 and avail interest expense allowance in 2020. So again, this is also a benefit, and 2020 year is what we can plan around and think of taking benefit of this provision. So I guess
definitely, yeah, I mean, definitely, Kavit. I mean, just one point which came to my mind is you mentioned about the carryback of net operating losses and the interesting 13 or 14% arbitrage which you mentioned in terms of the pre-2018 tax rate which was there vis-a-vis the 21% now. But let's assume a situation where the entity was profitable till 2018 or 2019, or let's say it started in 2017 and soon started making profits, and carryback of 2020 losses is to be done only to 18 or 19, where the tax rate was 21%, and the expectation of the tax rate increase in future. So one may also kind of weigh in terms of whether I want to carry back and claim a refund on the taxes which I paid at 21%, or want to preserve my losses in going into the future years, especially if I'm expecting the profits in 22, 23 in the near future and utilize it at a higher tax rate. So I guess, till the time, Biden comes with a tax change or tax rate change, there is going to be a certain level of uncertainty in the minds of taxpayers in terms of whether they want to carry back or carry forward the losses.
Yes, absolutely.
But one more thing, Kavit, I mean, since we are referring to this carryback, and can there be any planning opportunities around in terms of can there be certain acceleration of deductions and so on, which can be planned by the taxpayers, especially to enhance the losses, if at all there are any, given that 20 is the last year for which a carryback is allowed. Do you think any accounting method changes or anything is possible when filing a 2020 tax return to avail of the accelerated deductions?
Yes, absolutely, absolutely. There are, I would just name a few of those benefits that can be availed. So one, as you mentioned, the accounting method change. There is this accounting method change available for prepaid expense. So if certain conditions are met, prepaid expenses can be claimed as deduction in the year when it is paid, and not when it is claimed as deduction for the financial reporting purposes. So if we need to evaluate if we meet those conditions, and we can claim as deduction, and which can be beneficial to generate loss or maybe increase loss in 2020 tax year. Next, what we can do is, I would say, on the bad debt deduction, like in the current year because of the pandemic, there would be situations where where the recoverability might not happen from the debtors. So it is important that the businesses evaluate the recoverability criteria properly, and wherever it seems that the recoverability is not possible, they can think of writing it off in the books and claim, and even because for tax perspective also we can claim write-off if there for deduction for bad debts if there's an actual write-off in the books. So then we can claim a deduction even for tax perspective if there is, we are planning that if don't see any future recoverability from those debts. So again, that can be planned around, and we can increase losses to that extent. Third, I would say on the inventory obsolescence or write-off, mainly for the manufacturing industries or people who are in trading of goods, to evaluate more actively on whether there is any inventory which might be considered obsolete and can be claimed as write-off. This is very common practice for manufacturing or even the pharma industry. They evaluate at the year end what kind of inventory they believe are obsolete, and they claim a deduction for that. And for tax purposes, we can claim an actual write-off for those for those inventories if they have become obsolete, and it's an actual write-off for the books. The fourth, I would say, is on the payroll-related liabilities. So it's a very common practice and common provision that we know is the 2.5-month rule for the payroll-related items, and those are allowed as deduction for accrual taxpayers only if they are paid within 2.5 months. So management should evaluate and see if they can accelerate the payment of these liabilities and claim deductions for tax purposes in the current year itself to obtain the benefit of the carryback and ultimate cash benefit.
Sure, thanks, Kavit. So I guess ultimately it's a combination of looking correctly at the provisions at the year end to see whether anything can be actually converted from provision into an actual write-off based on the actual occurrence of the event, crystallization of liability, or the actual loss happening, and claim it as a deduction in 2020 itself, than kind of deferring it to the future years. Simon, I would like to come to you now, and as we started, that one of the key changes in 2020 was the change in power, and Biden and his Democratic colleagues coming into the power. As a part of an election campaign, they came up with a tax plan, and from my reading of the tax plan, I saw most of the provisions to be quite unfavorable to the taxpayers, the tax rate, the AMT, GILTI, and so on. So the real question is, what are those changes? And more importantly, how and whether they will be able to bring this into the law, especially looking at the fact that the US is still recovering from the pandemic. So when can we see those changes, and what changes will we see? Your thoughts on that? Simon, you're on mute.
Sorry. Yeah, thanks, Shishir. Well, there are 4 major provisions that may negatively impact the corporations, and that's the proposed increase of the corporate tax rate, the AMT, offshoring, and GILTI. Well, you all have heard about the increase of the corporate tax rate from 21% to 28%. This will not be an easy task for Biden because he needs to rein in the left, which is suggesting a 35% tax on corporations. And at the same time, he cannot lose any centrist Democrats. And the 50-50 split in the Senate means that every Democratic senator, including the centrists like Senator Manchin from West Virginia, would need to support the bill for it to pass. Republicans are unlikely to participate in a corporate tax increase. On the other hand, I read today in an E&Y tax policy survey that respondents believe the likelihood that the corporate tax rate will be increased by 2022 is about 75%. So everybody is expecting an increase, maybe not to 28%, maybe to 25 or 26%, but everybody is expecting an increase, maybe not in 2021, because Biden places wants the economy to recover first, and then pay for the cost of the recovery. The proposed plan also creates a minimum tax on corporations with book profits of 100 million or higher. The minimum tax is structured as an alternative minimum tax. Corporations will pay the greater of their regular corporate income tax or the 15% minimum tax while still allowing for net operating losses and foreign tax credits. The key issue is that this AMT is based on book profits. The proposed plan is aimed at companies like Amazon that have large book income but pay little or no tax. However, certainly it would hurt other large companies that have high capital expenditures like manufacturing, energy, transportation, and logistics. From a book perspective, like Kavit mentioned before, the machinery has to be written off over the course of the life of the asset, but for tax purposes, bonus depreciation allows to fully deduct the cost of an investment. This policy is aimed at encouraging R&D spending, and we will see the impact that this AMT has on future spending. Potentially, the AMT may distort important investment decisions and may even interfere with some of the key incentives promoted by the Biden administration that I will mention a little later. Biden is also planning on imposing a new 10% surtax on corporations that offshore manufacturing and service jobs to foreign nations in order to sell goods or provide services back to the American market. This surtax will certainly raise the effective corporate tax rate. In addition, it may give the corporations additional headaches with respect to transfer pricing and record keeping. This is because our world is so globalized that certain manufacturing processes are performed in different worldwide locations, and businesses employ workers in countries across the globe. Supply chains that cross many borders and products designed in one corner of the world are regularly built and distributed in other part of the world. And so the question is, how do you report this? How do you calculate the base of this surtax, and how do you allocate it between the countries? So that might be a major headache for the corporations.
Right. I mean, again, and I guess, sorry to interrupt before you move to the guilty, but this also surtax comes with a very interesting thing. You mentioned about record keeping, which is extremely important, but also from a transfer pricing perspective in terms of how one looks at the transaction, because we had come across a similar situation when wheat was introduced as a part of TCJA, and there are so many US companies, especially the subsidiaries of the foreign companies, where the US company is merely a contracting entity. From a business exigency perspective, it's a contract entity. It may be performing the sales and marketing function. It may be compensated also on a cost plus markup for for the sales and marketing effort. But from a GAAP perspective, the entire revenue is recognized in the US entity, and after leaving for the cost and the margin for the sales and marketing, everything else is kind of shown as a cost of services, or as an expense on the debit side. It is often also called as an outsourcing cost. So can that be considered as a part of outsourcing, and that entity on the sales and marketing service profits which it is retaining be subject to this surtax, or whether the substance over form will prevail to say that, okay, this is not really an outsourcing, but it is more of a marketing income which has been earned by the US entity. So I guess documenting the transfer pricing is also going to be extremely important to defend the position if at all this surtax sees the light of the day.
Right. Yeah. And there's also a very negative potential proposal, which is the GILTI. And the key provision would double the tax rate on GILTI earned by foreign subsidiaries of US firms from 10.5% to 21%, which would negatively impact the tax rate. In addition to doubling the tax rate assessed on GILTI, Biden proposes also to assess GILTI on a country-by-country basis rather than the current approach, which allows businesses to blend foreign income that is taxed at a high tax rate with the income that is taxed as a lower rate. And that especially affects multinational corporations that have investments in many low or high tax rate countries. Additionally, Biden proposes that to eliminate the GILTI's exemption for deemed returns under 10% of QBA. And also, we have to keep in mind that the proposed tax rate increase will also impact the GILTI high taxes exception rules. The high tax exception rules apply only if the GILTI was subject to foreign income tax at an effective tax rate greater than 90% of the highest US corporate tax rate. If you raise the tax rate from 21 to 28 or even higher, then you will have considerably less income qualifying for that exemption. There has also been some talk about completely undo the high tax exception regulatory work being done by Treasury. Well, GILTI is already a very unique policy in the international tax environment, and increasing tax burdens on foreign earnings by limiting the general GILTI deduction, QBA, or removing the high tax exception, and may put US companies at a competitive disadvantage.
Thanks, Hemant. I guess you reaffirmed my understanding that most of the provisions are kind of unfavorable. But I also understand that there are certain benefits. So Biden obviously wants to promote the Make in America policy, and that's where a certain credit, certain incentives are being also offered in case of manufacturing. If you want to do the manufacturing in the US or revamp your businesses in US, so there's a benefit also which is associated with that. So anything on that?
Yeah, definitely. So the Biden tax plan establishes an advanceable 10% Made in America tax credit for activities that restore production, revitalize existing closed or closing facilities, retool facilities to advance manufacturing employment, or expand manufacturing payroll. This tax credit may indeed encourage investment into highly modernized machinery that helps at producing more in the US at affordable prices. And if manufacturing facilities are outfitted with robots that can perform certain tasks quicker, cheaper, and more reliable than humans, it might make sense to insource again and produce locally, made in America. And also the pandemic has shown that it's very important to produce certain products locally in the US, because if it's stuck somewhere else and nobody can travel or ship goods, then it provides a problem.
Yeah, definitely, definitely. So
Yeah.
I will kind of take a lead from your last statement. So when I move to Pratik here now, and you mentioned about the supply chain, you mentioned about the disruption, and 2020 was definitely one year with a lot of business disruption, which impacted the intercompany transfer pricing policies of a lot of companies, and they were required to relook at the intercompany transactions, intercompany agreements, and so on. So, Pratik, we would like to hear from you as to how you look at transfer pricing in the COVID scenario and how that was different, and transfer pricing documentation being a first line of defense. How would you look at in terms of strengthening the transfer pricing documentation?
Sure, sure. Thanks, Ashish. So certainly, the 2020 was, a year of uncertainties, and rightly pointed out by, there was a supply chain disruption. So, in order to minimize the risk, various MNEs had to, they were forced to change the functions. There was a shift in function from one entity to another entity, and which may lead to, business restructuring. So what one needs to look at is, whether there is any change in transfer pricing arrangement is required, whether any exit charge is required. So as TP is, very subjective, so it has to be done on a case-to-case basis, based on the facts and circumstances of each case. Now, second major challenge here is uh, on compensation of low-risk distributor and captive service providers. So here, a lot of distributing entities are incurring losses, and at the same time, there is no sale happening, and they had to, incur certain expenses. So in this case, which entity should bear the cost, whether it has to be borne by the manufacturing entity or the distributor. Similarly, in case of captive service providers, so historically they were being compensated on a costless basis, but due to this COVID-19, when group as a whole is incurring losses, whether there is any room for reduction in markup, or whether parent entity can pass certain risk to this limited risk service providers, that needs to be taken care of, because whatever position the taxpayer is taking now will have consequences in futures. So this aspect needs to be considered. With respect to allocation of cost, so various entities have have formed a COVID crisis management team. So this may require additional allocation of cost to all the group entities receiving benefits. So here need and benefit test is very important here. And lastly, whatever position a taxpayer is taking, their TP outcome should align with the value creation and allocation of risk.
Sure, Pratik. But I guess one more point I would like to kind of emphasize on is the TP documentation. And I understand that IRS came with best practices FAQs on TP documentation last year itself. And that only enhances the importance of having the taxpayers maintain the TP documentation on contemporaneous basis. Your quick 1 minute thought on that, Pratik.
Right. So, we have seen, over the past few years, there was increase in TP audits by the IRS, and so there was no COVID-related TP guidance from IRS. But certainly, in April 2020, IRS come up with a FAQs on best practices in for TP documentation, and some of the aspects, some of the key takeaways from that guidance or the FAQ is, one needs to maintain contemporaneous TP documentation. Additionally, in case in case of losses, one need to justify whether this losses is due to intercompany pricing policy, or is it due to any external factors that have impacted the taxpayer. Secondly, in case if we are planning to make any adjustment due to COVID-19, so taxpayers should provide, the rationale for this kind of adjustment and how the adjustment have been computed. So in all, I would say, a TP documentation would play a really important role here because, now IRS is going to, I mean, what we expect is that, post-COVID scenario, the IRS will, shift its focus on TP and it would like to know about the reason for the losses.
Sure, Pratik. Thanks. In the interest of the time, there is this quick tax update trends for 2021, which we want to discuss. But in the interest of the time, just quickly, Kavit, you have only 2 minutes. So, your, 2 or 3 important pointers on what to look at in 2021. And then, Dharmesh, over to you for the state trends for next couple of minutes.
Sure. So yeah, so basically if I do it for 2021 and beyond, the changes that might happen is first is on the bonus depreciation under IRC section 168. So currently we are eligible for 100% bonus depreciation, which will continue till December 31, 2022. But post that, there will be a gradual phase out of this bonus depreciation, 80% in 2023, 60% in 2024, and 40% in 2025 and 20% in 2026. So beyond which there is, as far as the current law, there will be no bonus depreciation. So on the bonus depreciation will gradually phase out from now on. The second aspect is on the 163J final regulations that have come, and as per that, the current adjusted taxable income, which computation, which includes add back of depreciation and amortization expense, that will be will no longer be available. So the adjusted taxable income will be equal to the EBIT, only the net interest expense which will be added back to the adjusted taxable income. So again, the allowable limit for the interest expense might significantly reduce for taxpayers who have significant depreciation and amortization expense. So
thanks, Kavit. Dharmesh, quickly.
Sure. Yeah, the state trend has always been there. What we have followed for the past 2-3 years. I believe the similar trend will be followed in the next year as well. So more and more state will follow the market approach method or the single sales approach method. Other than that, there are a few states who are planning to increase the revenues and trying to capture more entities by proposing worldwide versus a what is election. So a few states are in a proposal stage for worldwide reporting, wherein you'll have to report your say sales or revenue from other countries, not just US jurisdiction. There are also a couple of states like Pennsylvania who are trying to bring in the combined filing or unitary filing methodology for states. This is also done so that more revenue can be earned by the states.
Sure. Thanks, Dharmesh. And I guess that brings us to the end of this session. But before we conclude, we have received a few very, very interesting questions from the audience, and I would like to take 2 or 3 of them, at this point. So my first question is to Kavit. The question is, coming from a pharma client, and the question is, in case of inventory write-off, can we write off the accrued amount for risk inventory, even though it is not actually destroyed?
Okay, so this is pretty interesting situation, and as you mentioned, this is coming from a pharma client. A lot of time, the pharma client, they have this provision for inventory, kind of expired goods that they say, and generally, if the expiry is nearing around 6 or 9 months, they don't expect that there would be any buyer against that. And that's where we can consider it's on a case-to-case basis. We need to consider what is the expectation of this inventory being sold off in future, and accordingly we might consider claiming a write-off. But as the law goes, you cannot claim generally until and unless you actually write off the inventory. But in this scenario, specific scenario, we might have to evaluate in detail and understand nitty-gritties of that.
Right, right. I mean, what I would only like to add, Kavit, to this is that since the question mentions about it not being actually destroyed, so if the inventory has really turned bad and it's ought to be kind of written off, but it's only if it's a procedural matter, because sometimes in pharma industry, I mean, there is a certain time frame beyond which, once a certain quantum of inventory is accumulated, then it is destroyed, because it's even destroying the inventory is a expensive process. So if it is just a procedural aspect of destroying the inventory which is pending, but the inventory has really turned bad, there may still be a good case to claim it as a write-off in the current year itself.
Yes. There might be a good case for that. We might need to, yes, obviously we need to evaluate, but yeah, that might be a good case for that.
Correct. Simon, the next question I'm directing it to you. So it's received from one of the participants, and it's with respect to the 10% surtax which you referred to. And the question is, the company is into the staffing business, and it has an affiliate in India which assists the US entity with the recruitment process outsourcing service. So, which is not directly kind of delivered to the end customers. It is just assisting in the recruitment process, and it is not a part of a billable service which is provided by the US entity to its end customers. So, would such kind of of services be even considered for the 10% surtax?
Well, it depends how it is recorded, but if it's not billable, I would think it should not be subject to the 10% tax. But the companies have to be really careful how they record it in the financial statements, because that's what I said before. There are so many cross-country transactions, and it's very difficult to determine what is the base for the tax, 10% tax. So definitely we will have to look at each transaction separately.
No, I agree with you. I mean, because this is not really, it's one of my cost centers which I am kind of outsourcing. I mean, it is nothing to do with my end deliverable, frankly. So there may be a good chance of this not being considered, but obviously, it is still not a law, and regulations are far away. So we'll have to wait and watch. My last question to Dharmesh, and this is with respect to the telecommuting nexus, what we were referred to. And the question is that on the work from home, is there any way clients can take benefit, particularly like us? So again, this is a question from a staffing company who are all temporary staffing. So I will have you respond, Dharmesh, but my only initial thought would be this word temporary is very interesting, and I don't know whether any states have really defined temporary. So whether the intent of this was that 3 years, 3 months or 6 months, by the time the employees are not able to really work from their offices, are they working from the homes? That's the only way it is being looked at, and it's not kind of a perpetual situation where the business model itself turns into a work from home model and you allow nexus not to be created. That's my thought, but again, I will leave it to you, Dharmesh.
Absolutely, Shishir. I agree with you on the points. So basically, there is no definition as such being provided by a state wherein they are defining temporary working conditions, but it's just they are saying when employees are displaced from their regular course of location of work and are displaced from their original workplace. So that is the ideal definition that they have come up with. So I would say that just because you are into a staffing business and you want to take this as an opportunity, I would not suggest you to do that. It would be, in hindsight, it is just a temporary relief for those entities who are actually facing this situation.
Sure, Ramesh. So I guess there is one, I would take one more last question. I mean, it has just come in. So I would like to take that. And again, Simon, it looks like the surtax is a hot topic today. So there's another question for you on the 10% surtax. So is the 10% offshore penalty surtax applicable to the companies wherein the US-based subsidiary is a marketing arm of the patent company, of the parent company? I guess that's what is required. Parent company based in India and uses cost plus basis for the intercompany transactions. We are into providing the services to healthcare providers, physicians, and clinics.
Yeah, that's a difficult question.
Yeah, but I guess, Simon, I mean, my take on this would be, I guess this still emanates and, from the,
yeah, I would say if it's managed here and under cost plus method, I would not see any problems with the 10% surtax.
Yeah, because this would be more of a marketing or a support service fee, which is earned by the US entity, than really the offshoring which is happening. But for the
right, I think the 10% surtax is more aimed at companies that like Apple that cuts through the iPhone in China and then import it back to the US, for example.
Right. Yeah, I guess that's it from our side. Over to you, Christine, for the final remarks.
Thank you, everybody, for joining us. I hope that you learned a lot. And please feel free to reach out to our team if you have any questions. Thank you very much, everybody. Bye-bye.
Thanks, everyone.
Bye-bye. Thank you.
Thank you, everyone.